So, what if I told you that an AI trading bot with a 70% win rate could actually be, like, mathematically guaranteed to bankrupt you?
Yeah, I mean, it totally flies in the face of that ultimate modern investing dream we're always sold, right?
Exactly.
Yeah.
You know the fantasy. A machine just quietly running in the cloud somewhere, instantly digesting global financial data and executing flawless trades.
Right, with zero emotional baggage, it never panic sells and never gets greedy. You just sit back and watch your account grow.
Which sounds amazing, but, well, that's exactly our mission for today's deep dive. We are tearing down that specific fantasy.
Because when you look at the actual source material on algorithmic trading in the wild, the data paints a vastly more complex and frankly dangerous picture.
Right. So we're going to look at why those easy money strategies are evaporating and break down the highly specific traps that just crush beginners who blindly trust these algorithms.
And most importantly, we'll explore the core framework, the 4 concrete improvement steps you need to actually make AI work for your portfolio.
Because if you're listening to this and thinking, I'll just find a smart bot, flip the switch and head to the beach.
You are the exact prime target for the traps we're going to discuss.
Exactly. Whether you actively trade or just want to understand how automation is, like rewiring global wealth, seeing the mechanics under the hood, really changes your perspective on the future of money.
Totally.
So, okay, let's unpack a core assumption first. There's this lingering fear, or maybe a hope for some people, that as AI gets smarter and more accessible to everyday retail traders, we eventually just hit a wall.
Ah, the market freeze myth.
Yeah. Like, if everyone has a flawless algorithm processing the exact same global data, doesn't everyone just look at a chart, see an upward trend, and simultaneously scream buy?
Right, and the implication there is that the market just completely freezes up. If every single bot demands to buy, there is absolutely no one left to sell to.
Which makes sense logically.
It does, but it stems from a fundamental misunderstanding of what the market actually is. A lot of people subconsciously treat short-term trading like a spelling bee.
Meaning there's an objective right answer.
Yeah.
And if we all just study hard enough or buy a smart enough AI, we all get the word right and get a trophy.
Precisely. But the financial market, particularly foreign exchange and short-term equities, it's entirely relative.
Right.
If you're buying an asset because your algorithm predicts it's undervalued, you require a counterparty who believes, for whatever reason, that selling it at that exact moment is their best move.
You literally need opposing viewpoints to make the transaction happen.
Exactly. I mean, you need opposing views just to execute a single trade.
I really love the analogy from the sources here. It's less like a spelling bee and much more like a massive global poker game.
Right.
Every single player at the table has a completely different size stack of chips. They're playing by slightly different rules, and they all have entirely different goals for when they want to cash out.
The asymmetry is basically the engine of the market. Like, let's look at how that plays out mechanically. Imagine 3 different market participants using highly advanced AI models. The first is a retail scalper operating on a 1-minute time frame. Their algorithm detects a microfluctuation in momentum and signals a buy.
Planning to hold it for, what, exactly 90 seconds?
Right, before selling. But meanwhile, someone else's bot is looking at the hourly chart, seeing choppy macroeconomic resistance and telling them to hold off entirely.
Ah, so totally conflicting signals based on the time frame.
Exactly. And a third participant might be a massive multinational corporation. Their AI isn't trying to time a technical breakout at all.
They just need to move money.
Exactly. It's simply executing a mandate to convert $1 billion into yen over the next 3 days for a corporate acquisition. They just want to minimize market impact.
So they're slowly selling into the very same market the scalper is buying into.
Right. So even if the underlying AI is identical in its processing power, the differing objectives prevent any kind of universal gridlock. There's always friction.
Okay, I get that. But wait, even with vastly different goals, isn't the AI still processing data in milliseconds?
It is.
So won't the bots just snatch up all the obvious, easy winning hands before human traders or less sophisticated bots can even react?
Oh, they absolutely do. And that leads right into the beginner traps. The sheer speed of algorithmic processing means that simple historical inefficiencies, they just evaporate almost instantly.
Right, like those old bread and butter strategies.
Yeah, think about waiting for a short-term moving average to cross above a long-term one, or looking for an oversold signal on a momentum indicator.
Or trading the initial jolt when a company posts a massive earnings beat.
In the past, a sharp human trader could read an earnings headline and execute a trade fast enough to catch that price movement.
But now,
Now, natural language processing algorithms read the report, instantly cross-reference the sentiment with historical price action, and execute massive block trades before a human can even register the headline.
wow. So the opportunity is just priced in immediately.
It's a total paradox. The more investors rely on AI to find an edge, the faster the broader market absorbs that edge. It makes it significantly harder to win using just a basic out-of-the-box AI setup.
Which creates an incredibly hostile environment for newcomers. And the source material highlights some severe traps that basically swallow beginners whole because they assume the AI is just a magic wand.
Yeah, and that brings us back to your question at the start of the deep dive. The 70% win rate that guarantees bankruptcy.
Yes, let's break that down because intuitively, winning 7 out of 10 times sounds fantastic.
That is the win rate illusion. The raw percentage of winning trades is actually a fundamentally meaningless metric if you don't calculate the risk to reward ratio.
Okay, so how does it trick people?
Well, beginners will buy a commercially available trading bot boasting a high win rate. The algorithm is programmed to take tiny incremental profits. It buys, the price ticks up a fraction of a percent, and it cashes out immediately.
Just to secure the win for its marketing statistics.
Yes. But to achieve that high win rate, the algorithm's stop loss, the point where it finally admits defeat and sells a losing position, is set incredibly wide.
Oh, I see where this is going.
So when one of those 3 losing trades happens, the market drops and the bot just holds on, waiting for a rebound that doesn't come.
And that single loss wipes out the accumulated profits of 30 tiny wins.
Exactly. The architecture of the strategy ensures a slow bleed towards zero.
It's like running a business where you sell thousands of products for a $1 profit, but 3 times a year your warehouse catches fire and you have no insurance.
That is a perfect way to put it. You're technically succeeding most days, but your business model is inherently doomed.
Man, that's brutal.
And that leads directly to the second trap, which is all about risk management, specifically poor lot sizing.
Right.
What's fascinating here is that the AI's prediction can be entirely accurate, but the human user still loses their entire account balance.
Wait, really? The bot says the dollar will gain strength, the dollar actually does go up, but my account still goes to zero.
Because markets don't move in clean, straight lines. They oscillate. Let's say the AI makes that correct prediction. The beginner, feeling immensely confident, sets their leverage recklessly high.
They're risking a massive chunk of their margin, hoping for a huge payday.
Right. But before the dollar surges, it experiences a perfectly normal, momentary dip of just a few pips. Just background noise.
But because they're so leveraged, that tiny dip eats through their available margin.
Exactly. The broker's automated system steps in and liquidates the position to prevent further losses. They hit a margin call over a meaningless wiggle.
And then, an hour later, the dollar rockets upward, exactly like the AI predicted.
The machine was right about the direction, but the human's failure to manage the physical realities of leverage destroyed the portfolio. AI cannot save you from your own terrible money management.
Which feeds into the overarching psychological trap, right? The overconfidence and blind trust built on sterilized backtesting.
Yes, exactly. A beginner runs an algorithm against the last 5 years of market data. They see this gorgeous, smooth line charting imaginary profits, and they think the machine is invincible.
Without realizing that a backtest is basically a vacuum.
It's analyzing the past in an environment entirely devoid of actual market stress. If you rely solely on that, you have absolutely no idea why the bot enters a trade.
And if you don't understand the underlying logic, you're paralyzed when the market shifts and the bot suddenly hits a losing streak.
Precisely.
So, if buying a bot, jacking up the leverage, and blindly trusting the backtest is how you crash the sports car, how do we actually drive it?
Right, how do we fix this?
The sources lay out a very specific 4-part framework for successfully operating AI, and it starts by addressing that sterile backtesting problem directly. Step 1 is data quality.
The foundation of algorithmic success is acknowledging that the real world is incredibly messy. If you train your model on idealized, clean historical charts, it will panic in a live environment. You have to feed it the noise.
Give me an example of the noise. What does the AI experience live that doesn't show up on a pristine chart?
Spreads and slippage are the biggest factors. The spread is the gap between the highest price a buyer will pay and the lowest a seller will accept. In a calm market, it's tiny.
But during a news event, like a surprise interest rate hike, that spread blows wide open.
Exactly. And slippage is the execution delay. By the time your algorithm decides to buy and the signal hits the broker's server, the price might have jumped.
So if your training data assumes instant execution at perfect prices, your projected returns are just fiction.
You must force the AI to learn in environments simulating wide spreads and execution delays.
Okay, so that's step one. But step two, this was the biggest aha moment for me in the sources, designing the sit-out.
Yes.
Beginners want their AI to constantly hunt for the perfect moment to trade. But the real secret is programming the AI to know exactly when to do absolutely nothing.
Teaching a machine restraint is arguably more valuable than teaching it aggression. An AI that aggressively hunts for marginal wins in terrible conditions will bleed you dry through transaction costs alone.
So instead of just a list of rules for buying, you build a massive wall of rules for sitting on your hands.
Let's walk through a scenario. Say your AI detects a textbook momentum breakout, normally a massive buy signal, but it cross-references its sit-out rules. Rule 1 is overall market volatility too low.
Right. If the market is sluggish, that breakout is probably a false signal.
Exactly. So the bot aborts the trade, or maybe there's a highly anticipated employment report dropping in 20 minutes.
Pre-news environments are chaotic.
Right. Rule 2 kicks in: no trading in the pre-news window. The mathematical probabilities break down during those irrational price spikes, so the bot goes dormant until the market digests the shock.
Avoiding a highly probable loss is mathematically identical to securing a profit. That's a massive paradigm shift.
It really is.
But even with a smart bot that knows when to sit out, there's still the human element. Which brings us to step 3 operation rules. Setting hard boundaries to protect the AI from the user.
Because this is where the emotional component creeps back in. An investor deploys their carefully trained algorithm. It hits a rough patch and loses 3 trades in a row.
The account balance dips, panic sets in, and they manually log into the terminal.
Yes, they override the system. They manually close a trade early out of fear, or they tinker with the stop-loss settings to give a losing trade more room to breathe.
Which is so ironic. People think they're letting AI handle things, but then human emotion kicks in and they ruin the strategy.
By intervening arbitrarily, you are just emotionally trading with extra steps.
Yeah.
You completely destroy the statistical advantage the system was built upon.
So you need a predefined contract with yourself. Like if the bot hits 4 consecutive losses, it automatically suspends trading for 24 hours.
Or if the total account drops by 5%, the system halts pending a manual review. You dictate the conditions for intervention before the emotional trigger occurs.
Right. Which brings us to the final piece of the framework. Step 4, the improvement system. I think marketing suggests building the bot is the finish line.
Oh, not at all. Deployment is barely the starting line. It requires rigorous daily auditing. The market is a continuously evolving ecosystem.
So what works in a low volatility environment gets shredded when central banks pivot.
Exactly. You have to treat the bot's daily performance logs like a forensic investigation. You look at the logs and ask, why'd this trade stop out? Was the initial logic sound, but the stop loss was just too tight?
Or why did this trade win? Did it win for the reasons we programmed, or did we just get lucky on a random price spike?
Right. You're analyzing the metadata of your own algorithm's performance.
So the work just shifts. You aren't staring at charts looking for crossovers anymore. You're doing homework on your AI, which makes me ask, what does this mean for the everyday investor?
What do you mean?
Well, we started this deep dive talking about the dream of sitting on a beach while the AI prints money. But it sounds like managing an algorithmic portfolio requires an immense amount of oversight and discipline. Is the AI advantage just a mirage?
It isn't a mirage, but the nature of the advantage is completely misunderstood. If we connect this to the bigger picture, AI won't create a future where everyone magically wins.
Because the market is relative.
Right. Instead, its true power is acting as an impenetrable guardrail against human stupidity. It creates a future where people stop making careless, unforced errors.
Ah, I see. So it blocks a user from executing a lot size that risks 40% of their margin.
Exactly. It refuses to let you average down on a losing position out of desperation. It locks your terminal 3 minutes before the Federal Reserve speaks.
It eliminates the rookie mistakes. But wait, if everybody is using AI and everybody has these guardrails, the overall skill level of the market is going to skyrocket.
Yes. The lazy, low-hanging strategies will die permanently. The new paradigm treats the AI as a highly capable employee. It processes mountains of data, but you remain the ultimate supervisor.
You have to doubt the AI, verify its data, and supervise it. Your edge isn't letting AI predict the future. It's using AI to relentlessly isolate and eliminate your own losing patterns.
That is exactly the takeaway.
Okay, so bring this all together. We set out to uncover the reality of AI in the markets. We saw that the market freeze is a myth because players have entirely different goals.
Right, the poker game analogy.
And we saw how beginners get crushed by the win rate illusion, terrible lot sizing, and blind trust in backtests.
But we also outlined the survival guide.
Yes, the 4 concrete steps. Using high-quality, messy, real-world data. Teaching the AI when to do absolutely nothing, setting strict operational boundaries to keep human emotion out, and obsessively reviewing the logs to improve.
It totally redefines the relationship between the investor and the technology.
It really does. Delegating tasks to AI is fine, it's powerful, but delegating the responsibility for your capital to a black box is a recipe for disaster. You are still the one defining the rules.
Which leaves us with an interesting paradox to consider for the road ahead.
Ooh, what's that?
Well, this is something for you to explore on your own. If AI eventually acts as a perfect safety net, preventing all human emotional trading errors and reckless money management for everyone, will the financial markets simply become perfectly efficient and static? Or will human beings just invent entirely new, incredibly complex ways to make irrational financial mistakes?
Oh, wow. It really makes you rethink the pursuit of the flawless machine. Because as long as there is asymmetric human desire driving the underlying capital, the game will never stop. It will just demand a much smarter player.